Guys, today we're going to discuss SMC, lesson one. Let's say introduction to smart money. We did the video the other time on demand and supply, and we said demand and supply is the most basic thing that will guide you on how to get the smart money zone. Right? Jote, kila kitu sawa? Alright, meanwhile, for those who are listed, gold. Gold today, yesterday, I gave out the signal. We are buying at 25.65, and I'm expecting this market to create a new high. So expecting SMC later this week, today. So there's high possibility that if SMC will become negative for the dollar, then gold is going to make a new high. So if you're in this buy, let's say telling myself, then your TP should be at 25.95. So there's high possibility that we might hit 26. Just take your TP at 25.95, then call it a week. So now, this video is recorded. If you're going to miss the whole of whatever I'm going to discuss today, there's a YouTube channel, and go there, you follow, subscribe, and I'll watch later. So today I want us to talk about SMC. Smart money concept, SMC. Hey, is that funny? Let me use a different color. Is it coming out pretty? Let me check. Okay. Yep. So, I want us to have a general discussion on SMC. Introduction part. So when we talk about SMC, it's all about, okay, in full is smart money concept here. Right? Hold on. Nothing better. Black. Let me test the black. Black is better. Okay. Then so left, right. So probably this one. Okay. SMC means smart money. Money concept with my other thing. So smart money concept is all about, in general, how institutions and big investors trend. Okay, so this is how big institutions or big investors trade. So big investors in this case are like gym banks. Okay, so it means that when you're trading with this concept of SMC, you're trading with a bank. So now, it is good to note that, let's say for example, there's a high supply of the dollar in the market. So it will take these institutions to create demand for that particular currency through, let's say, raising interest rates. So if, for example, the Kenya shillings is going to mean CBK is going to raise interest rate, it means that they're going to create demand for the dollar. For Kenya shillings. If they're going to lower, it means that they're getting good supply of our Kenya shillings. So it means that these institutions or the financial institutions are the one who controls the demand and the supply of the currencies or the instruments that you're trading in the forex market. Okay. So remember, this concept can also be applied in instruments like gold. Okay, so you can trade gold with these commodities as well. Oil, after etc. So in other words, you can as well apply the concept in other financial instruments. not only in forex, okay? But in this case, we're going to give example. I'm going to give example with forex pairs. That means that we're going to have a clear demonstrations on how to identify these zones of SMC, right? So if you have any questions, you can put in the comment section. Bro, you can read the comment. So whatever these guys wants to be demonstrated, we can do it here. So now, let us come to the screen. We're going to use GBP, USD, and for you to understand this concept of SMC, you need basic knowledge on the demand and supply. Okay, so you need basic knowledge on demand and supply. So on GBP, USD, you're buying as well. So you get the signal in our group with our forex. We are taking a trade at this particular point here. There's a reason why we are taking a trade at this around 1.2316. So now, let me take you back to I have a clear smart money zones. So first of all, we're going to use two main concepts of our smart money, two main activities. These are accumulation and distribution of orders. Accumulation and distribution of orders. So now, let's try and check a perfect example on the same. Okay. Exactly. So now, before we come to the charts, I'll give you the overall concepts. I mean, the overall stuff that we're supposed to consider when you're trading with SMC. First of all, we need to consider liquidity. Okay. Secondly, we need to consider the smart money zone, smart SMC zone, SMC. Let me say activities through identifying the zones of demand and supply. Okay. Third, imbalance, very, very important. What else? We have the liquidity, we have the demand and supply concept in this point. I mean, at this particular point, the demand and supply. That is why we apply the two main activities of smart money, the accumulation and distribution. Then we have the imbalance. What else? What else? No, the character will come later. So now, so on this chart, I hope it's clear. The cameraman. So on this chart here, we have GBP and USD. Have GBP and USD on the screen. So first of all, we'll consider where this market was coming from. You see, so we had a downturn from this particular point, general downturn to this point here. So ideally, we had an accumulation of orders. I don't know if it is visible. So we had an accumulation of orders at that particular point. And then the market went buy. See? So at this point, the market formed a buy. I hope this green color will be visible on the video. Let me use blue with a black background. I think, yeah, it's okay. So we had a seller up to this point, right? Then the market formed a buy. So after an accumulation, the market formed a buy, and you realize that the regular pattern of a sell was broken. So the regular pattern was in a general downtrend. So we had the general downtrend, this regular pattern. So we had a general downtrend to this particular point. But after this accumulation, the market formed a buy. So I can say there's a Now there's a new character that is formed at this point here. So after the accumulation, we had a buy. So it means that this buy was somehow, let me say, a high risk buy. So you could not take a buy at this particular point. Even in the lower time frame, you realize that the buy could not be that clear. You see? So the market went to this point, and we had another point where we had, let me say, contraction of price. So we had another contraction of price at this point. You see? So we had a contraction of price at this point, then we had a buy. We had another contraction of price at this particular point, then we had a sell. So now, in this case, on the sell side, the accumulation, or I mean the contraction of price before a sell is what we are going to name as a distribution. So there's a distribution of orders. Sometimes when you see the market is consolidating, so a retail trader might wonder, why is it that the market is not selling or is not buying? Okay, so that is now how smart money creates orders. Okay, so they create volume for future use. So in this case, we have distribution. I'm trying to summarize this concept. We'll have the video posted on our YouTube channel. So we had distribution of orders. Visible? Let me try and change the point. So we had distribution of orders at that particular point, and we had an accumulation of orders. In other words, accumulation is a smart money way of collecting or creating buy orders, and the distribution is a smart money way of creating sell orders. So in this case, we have two zones. We have the distribution part and we have the accumulation part. So after the accumulation, or what confirmed that there is an accumulation, which is this buy, and not confirmed there is a distribution, which is this sell. So it means that this was a random sell and this was a random buy. So ideally, a smart money trader could not take trade at this particular point, at this buy, and at this sell. So what do? We wait for the confirmation now. Confirmation is when the market now will fill up the imbalance, because when we had a sell at this particular point, this impulsive sell we call imbalance of orders. Okay, so others will call it. We'll translate the zone or the characterizer as what, Jonte? Fair value gap. So in this case, we have an imbalance, right? We have an imbalance at that point. So we cannot take this sell. So ideally, a smart money trader cannot take this sell. Okay, so a smart money trader will wait for the market to come to this point so that the order. But before the market comes to this point, it will give you several traps. Okay, so and the traps that will be created here is this. See, some equal highs. So it depends on how you're going to translate it. So when I said known as some equal heights that have been formed there. So ideally, most retail traders will start taking their sell. See? So most retail traders will start taking their sell at the equal highs. Most retail traders will start taking their sell at these equal highs. So now, let me give you a scenario. So smart money, okay, the concept of smart money goes hand in hand with liquidity providers. I mean, not liquidity providers, but now, let me demonstrate this. Purpose of market makers is to provide liquidity in the market, right? So now, liquidity is all about volume. So at this particular point, that is where retail traders are going to place their orders, their sell orders. Okay, and stop loss, of course, will go slightly above the zone. Then all of a sudden, the market will take them out, activate the buy stop orders, take them to the smart money zone, then start selling. Are you getting that concept? Yes. So in other words, let's say you have a volume of 20. 20k USD. No, 20 billion. 20 billion USD on the upper side, right? And we have a volume, the sell volume over 10 billion USD. So now market makers are looking for volume. So if this $20 billion is located at the smart money zone, okay, it means that the market is more likely to go up to the $20 billion so that it can take the volume, right? So assume it needs 10 billion more so that it can initiate the sell. So it means that in this 10 billion, 20 billion, we're going to take 10. So that we can have the 20 on the sell side and 10 on the buy side. So ideally, the purpose of this market coming to the smart money zone, which are the distribution zone, which are on the smart money, on the what do you call it? Demand and supply concept. We say the entire zone now is the supply zone. But the smart money will explain to you where the orders lies. And the orders lies, the sell orders will lie at the distribution. And this particular price that costs now the impulsive sell is what we call the order block. So we have a specific lesson that we will discuss about the order block thing. So now you see, the market used this zone here, this particular point here as liquidity. So I hope it's visible, so you can So you see where the order was taken. So retail traders were taken out as liquidity. The market went to the smart money zone. Then we had a sell to where? Remember, we had an accumulation here where the entire zone now is where we have buy orders. So now for the accumulation, the entire zone will be named as a demand. And our interest is this particular price where we had the buy pressure. So it means that the market went to the demand zone. Boom, go ahead, and the sell. So we have the imbalance here. Right here we had an imbalance, very clear, and it was filled. So after filling up the imbalance, the market will go to the possible demand and supply zone, or the smart money zone. We had the order, then we had the sell too, where we had another smart money zone. Then boom, a buy. So ideally, you realize that after smart money zone has been tested, the first time, it means that the second time the market coming to that particular point will be taken out, right? It means that the smart money zone will only be tested once. So the first test means that the market has already utilized all the volume that have been placed there. Yep. So in our next lesson, we're going to discuss what's order block. So let's make sure you subscribe to our YouTube channel, share, put in the comment section what you want us to cover. Cheers. Say hi.
Hello. It's a hello.